And all of a sudden you look at the banks and you're saying, unless you have real scale, unless you're JP Morgan, unless you're, kind of one of these big G-SIBs, unless you have real scale, like it's hard to see how you compete going forward on any vector relative to tech first, digitally native first payments company, relative to some of these specific narrow banks, and then relative to what will be, call it the insurance companies and the alternative credit providers out there who will now have cost of capital that might be closer to you if the deposit base rises. So that was a really long-winded answer, but I am pretty bearish most banks in the US.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name is Andrew Van Aken, data scientist at Artemis, a crypto analytics startup. I'd like to welcome you to Stablecoin Stats, a monthly show on the Tokenized podcast dedicated to the stats behind the stablecoin market. Joining me today, as always, is my colleague and friend Anthony M., co-founder at Artemis. Sir, how are you doing on this fine and cold morning?
Very well, thank you.
And today we have someone who needs no introduction in the stablecoin space, Rob Hadick, general partner at Dragonfly. Rob, it's an honor. Thank you for joining us. How are you, sir?
Honor is all mine. I appreciate you guys bringing me on to, I think this is what, number 3?
Oh, we've done so many. I've lost track. The Stablecoin Stats. We can't even keep track of our own stats. It's a little disappointing. A quick disclaimer before we get into things. I need to remind you that the views or opinions of our contributors today are their own and do not necessarily reflect those of the companies they are representing. Nothing we say should be taken as tax, financial, investment, or legal advice. Do your own research. And lastly, before we get into the stats, I'm thrilled to remind you that this podcast is made possible by Visa and powered by Artemis. So once again, the theme of this show tends to be, Anthony, you go to somewhere very nice and warm while I stay home and continue to color charts in. Both of you were at Money 2020 this past month, and I believe also you were both at Token 2049. Curious what the attitude of Money 2020 was, and especially how did it differ from Token 2049? Rob, please go first.
Yeah, so anyone who doesn't know what Money 2020 is, and I'm guessing most of your listeners do, but it's basically the biggest fintech conference in the world. And that's inclusive of, call it, consumer fintech, but it's also very inclusive of payments, banks, anybody who wants to be in digital finance. And so how different it is than Token is probably as different as two things focused on a digital asset can be, right? Because when you're at Token, and especially in Singapore, it's really a retail sort of conference. So you go and there's all these big, places where people are, shilling you different types of tokens and protocols. And I walk through the floor of Token, and I gotta be honest, I invest full time in this space, and I know maybe 50% of the projects that have booths. Right? It's just very, very different. There's a lot of interest, but people also really want to talk about stablecoins. They really want to talk about real world use cases, but that's a segment of what they do. And then you go to Money 2020, and it's all of the big banks, all of the big payment networks, all of the big payment service providers, and all they want to talk about is stablecoins right now. It's basically stablecoins and agentic commerce. And it's actually shocking to me because there are all of these things that we could think about and talk about when it comes to, what's happening in the land of fintech, what's happening in the land of payments. But the only topic right now is stablecoins or agentic commerce. That is it. And I would tell you that 2 weeks ago I was at the Fed, and Governor Waller gave a speech to start this conference that they called the Payments Innovation Conference. And it was all about, bringing stablecoin issuers and other, call it, digital money movers into maybe something like a skinny master account or doing more innovation around payments. And if the Fed is talking about it, then the banks are talking about it, the PSPs are talking about it. And so it's the topic du jour. It's very clear that every single company that you've ever heard of that is doing anything around finance is actively working, thinking, and moving towards stablecoin rails right now.
Anthony, no, that's a great summary, Rob. Anthony, would you agree, disagree, or how did you see the difference between the two?
Yeah, absolutely. I mean, I think I can provide some anecdotal perspective. So I think Money 2020 is the first conference I went to that I actually saw a lot of my Harvard Business School colleagues at, and they were all talking about stablecoins. And I think up until this point, I have never met another Harvard Business School person in crypto, with some rare occasion. But the crowd between sort of the crypto conference and something like Money 2020, a mass market fintech conference. It's just like completely different. And so, when I was at Money20, I got a chance to meet up with some friends from top consulting firms. And, one of them who's a partner came up to me and they're like, crap, I should have taken this stablecoin project back in January when I was offered to lead it, but I thought it was a scam. and clearly that's not the case. I don't think stablecoins obviously are a scam. They're very important. And I think this is like, not only is the Fed talking about it, but everyone on the ground is all talking about the private companies and all these sort of quote unquote, like we use this term in crypto, is like normies, right? Are like, hey, like, wait, actually this thing matters a lot. And so it's happening.
Which one has better after parties? Money 2020 or Token 2049?
I wouldn't know. I need my beauty sleep to function well as a co-founder.
That's a great answer. Like he's sitting here on the podcast with his largest investor, and he's like, "Yeah, I don't do the after parties. I'm, it's all work, no play whatsoever."
I mean, he looks good too. He looks well rested, so maybe he's actually telling the truth. But okay, we'll find out.
It depends on what you're solving for. If you want to go to the club afterwards, maybe Token, but it's great events at Money 2020 at both.
That's good. That's good to hear. Well, we have an exciting update because this past month we released our survey on stablecoin payments, all things stablecoin payments, and Dragonfly, Castellan Ventures, and Artemis, we did a survey. I believe we released it last May, where we were one of the first to show, what our estimates are of actual stablecoin volumes related to payments. This is not lending, trading, or anything like that. It is really stablecoin focused payments. And a few weeks ago, we actually released an update to our survey where we are actually finding that payments volumes are growing 70% since February 2025. And what we're looking at now is a chart of different volumes of P2P versus B2B versus card. And you can really see that B2B is really just exploding here and leading the data. So, Rob, the first question to you, an actual stablecoin question, is why do you think the growth in B2B has been so explosive, and what do you think is driving this trend?
Yeah, so to me, it's not surprising. We've been investing in this trend for a while. I've written about this a little bit, but if you look at the last, call it, 15 years of payment innovation, there is actually, one trend that I think really sticks out to me. There's a bunch, but one trend that really sticks out to me has been that the movement away from, call it traditional, correspondent banking rails to alternative payment networks has continued to increase and increase at a accelerating rate of adoption, specifically for those who are less well served by the correspondent banking system. And those people are really, call it this like SMB tier of companies, as well as some of the, call it, I would say, outside of the normal economy type companies. So things like commodity brokers, things like some of the global international shipments for inventory management, certain types of inventory flows. Those types of people have just not been well served, especially as they move money globally, by correspondent banks, right? And so what we've seen is that we've seen a move, and this is pre-stablecoins, to things like Wise for Business, right, or Airwallex, or other types of tunes, right, other types of global, call it alternative payment networks that are doing things often like pre-funding liquidity in a bunch of different countries and then debiting and crediting people's accounts. And so it looks like it's this great user experience, and it's potentially it looks maybe instant or close to instant, right? But you're basically getting charged some sort of like capital cost and platform cost, et cetera, to do that. Well, all of those products have absolutely blown up over the last 10, 15 years, and stablecoins are just a better alternative payment rail, right? Like those companies are still not well served by the correspondent banking system. The correspondent banking system, if you aren't one of the largest clients of JP Morgan, is really, really hard to navigate. If you're in the correspondent banking system and you're in a non, call it tier 1 country, right? It's hard to navigate, right? You don't get great service. They don't want to take, settlement risk or any sort of counterparty risk. So you end up having, multiple days to weeks of actually settlement, right? It's really capital inefficient. And, a lot of what happens in, utilizing the correspondent banking system is that it's opaque. So you actually don't even know necessarily when you'll settle. right? And so the reason those people have moved to these kind of digital first products has been because they are just better served. They are the core customer. Now, all of a sudden, we've seen a lot of people understand that we can do that better with stablecoins. And a lot of those companies have started to shift over. And so we've seen that real acceleration for those types of use cases over the last, it's really picked up over the last, I would call it like 18 to 24 months.
Yeah, yeah. And do you think those stablecoin companies will kind of like replicate that wise playbook for business where now we see like tokenized treasuries, tokenized private credit? Like, do you see them then like further moving up the stack and offering these types of products?
Yeah, absolutely. I mean, stablecoins are, they're really, I think somebody else said this, who I forget exactly what it was, but they called stablecoins like digital oil, right? And I think the reality is that you have to have, call it that unit of account that everybody uses to be able to go and then do, call it tokenized treasuries, to be able to go then do other tokenized assets, right? But the ability to move assets 24/7 with programmatic yield generation, programmatic money movement, right? To be able to have something that is transparent and that can coordinate trust, that's clearly better than what we have already, right? But you needed that, call it the proliferation and liquidity in that unit of account to be able to do these other things. But I mean, you're seeing it right now at some of the fintechs specifically, where, they offered stablecoin transactions before because there was like US dollar just demand in, whatever locality they're in. But now all of a sudden they're, swapping you into some other type of tokenized asset or allowing you to trade other tokenized assets because of the fact that there's demand for that as well. And now you have this liquidity between those pairs.
Yeah, that makes sense. Why don't you think we've seen so much growth on the P2P side? I mean, it's kind of been flat, but on the other end, these companies like Wise, I mean, Western Union even just released a stablecoin. Remitly, all these like volumes have been growing, but we don't see this like massive shift to stablecoins. Why do you think that is?
I'd be interested in hearing Anthony's perspective here a little bit because you guys obviously know the companies that you surveyed better than I do. But I think some of this is probably just the sampling of who we actually sampled for this report, which is that it was definitely more crypto natives on the P2P side who have been doing this already and we're very comfortable doing this, right? I think when I look at, call it like domestic P2P, we've, obviously Venmo works really well for Americans, right? And people use that. Or if you're in Brazil right now, everybody has a Pix number, right? And they'll, send each other their Pix numbers, right? And that's very seamless. It doesn't necessarily, stablecoins don't necessarily offer like a much better product yet today in a lot of those use cases. That said, I think we are seeing some pickup at like, some fintechs themselves have started supporting this, right? But they're not necessarily the crypto natives. And the biggest stablecoin P2P transfer, providers today are like Binance Pay. And I actually don't think Binance Pay is growing that quickly in terms of new users, and they're already pretty saturated in terms of who they serve and how they serve them. And so I think this is a little bit just that that market ran ahead of B2B before people started to understand these other use cases, and now we're seeing slower adoption pick up in less crypto native distribution platforms, right? But I do think we'll start to see like P2P stablecoin transfers at some of these fintechs specifically. And the only thing that might be tough there for us to parse out from a data perspective is that some of those things happen kind of like on an internal ledger of that, whoever that fintech is. And so you have to get the data from them because they're not actually, they're batch settling end of day. So they're not actually like streaming every transaction to the blockchain itself. And so you can't necessarily understand exactly what, each use case is.
Oh yeah, I think Rob is like, yeah, more or less correct. There is this like funky. So I guess for the audience members who are listening, one thing to clarify is that this is all off-chain data provided by companies that have KYB'd or KYC'd their users, and so it's exclusive of like a non-KYC'd like wallet, like raw wallet to wallet transaction. And we did it this way because basically there's so much sort of bad estimations of stablecoin payments volumes out there that we wanted a more conservative, ground up, ground truth number. And so to Rob's point, it's like a lot of these KYB, KYC, like I don't think there is explosive growth for these like KYC peer-to-peer transaction companies, because it's like if you're making a cross-border transaction, you're probably, fairly well served by companies like TransferWise or Western Union. If you are bypassing Western Union, you're just doing wallet-to-wallet transfer, you're not going to be showing up on here. And if you're doing domestic transfers, the biggest, I think countries are, that would support these like P2P payments. They already have things like Venmo or like Pix, or like UPI or right. And so I think P2P is kind of like a funky spot. But I'm sure if we just like added just raw wallet to wallet transactions that are not KYC'd, I think that number would be much greater.
All right. Well, if you want to be featured in our survey going forward, we'll most likely be doing one probably in February or March of next year. So feel free to reach out to us. There's the last thing I want to touch on this is that we see this trend of only like as a power law of stablecoins, if you will. So what we're looking at here is the distribution between payments of different stablecoins, and by far the vast majority of payment providers are using either Tether or USDC. So Tether here is about 80% share of payments versus USDC, which is about 20% of payments. But when you look at things like RLUSD and USDG, which two stablecoins that actually have like broken the $1 billion mark this past week, RLUSD, Ripple's USD, has actually been primarily used in lending. So about 50% is locked in Aave or Euler. And USDG is like primarily held by custodians, these companies like Kraken and Robinhood for possibly like back-end use cases, not as used in payments. Rob, actually very curious to get your take here. Like, how do you see these different like use cases or like personas of stablecoins evolve over time? And yeah, curious your thoughts on RLUSD and the division between, Tether payments and RLUSD for lending.
Yeah, I think what we're starting to see now, and I wrote about this a little bit last year, which is that from a stablecoin issuance perspective, that's becoming more commoditized. And so what you're seeing is all of the stablecoin issuers are either just paying for distribution, right? So even Tether is doing this. They bought Rumble, right? Which then they came out and said they're going to put USAT into Rumble and they're going to distribute to I forget how many users are on that, but it's in the hundreds of millions of users, right? And so, they're paying for that type of distribution. They're investing in a lot of different types of companies that would use stablecoins. Circle is, doing some of the same thing. They're investing in different companies. They're also actually paying yield back to some protocols and some, call it apps and et cetera for distribution. USDG, that is their sort of kind of their go-to-market is that, hey, we'll give you, a lot of this yield as part of this distribution and to their the people that use them. And then RLUSD, to your point, Ripple is basically taking the other side of paying for distribution again, right? But they're not doing it through yield generation. But what they're actually doing is they're buying a bunch of companies who might use stablecoins, right? They're buying Hidden Road, which is, we'll at any given time we'll have like $2 billion of loans outstanding in stablecoins, right? They're buying a G Treasury, which is basically a Fortune 500 or call it typical company treasury management software solution that helps people move money around the world, right? And so you start to see what is happening, and everybody's realizing that just being a stablecoin issuer is table stakes. Like you have to have deep liquidity, you have to have the ability to have the right APIs, you have to have mint redeem, but you can't just do that. You have to be able to monetize and distribute in a bunch of different ways. And so that's why you've seen, Tether go and invest in those companies and buy Rumble. That's why you've seen Circle go and launch CPN and now Arc and trying to become more of a payments network. That's why you've seen Ripple buy these companies that you've talked about. It's because they understand that issuance is one part of the value chain and it's not the stickiest part of the value chain, right? And so you've seen these like deep network effects that existed for the early movers, and now that everybody's moving into that next generation, they have to do all of these different things, right? And so that's why we've seen Bridge kind of get into issuance. I think we're going to see a lot more companies get into issuance, and that's why we've started to see these white labeled solution providers also start to pick up steam, both in crypto natives and non-crypto natives, as people have decided that, maybe I want to, have my own branding around it. And we have companies like, Agora and Paxos and Bridge who are powering, and Athena on chain that are powering that. So I expect that we'll continue to see a little bit of fragmentation over time, but that the winners will still continue to grow at a really, really steady pace.
So like maybe these companies aren't paying like distribution costs per se, but they're buying like $5-10 billion companies that,
it's distribution costs one way or another, right? It's just like whether I'm paying yield or whether I'm, buying companies that I can stick my stablecoin into. Paolo loves to go on up during conferences, and I've been up there with him at Token. We did a stablecoin panel, and he loves to say, listen, like we don't need to pay for distribution, which is obviously incorrect because he is paying for distribution. He's just buying companies instead of paying out the yield.
Yeah. That makes sense.
Well, I have a question here actually. So it almost sounds like, by offering these wider ranging services, these issuers are, starting to look more like a bank. Is that like, and do you think that, what do you think is going to happen to banking in that case, right? It's like, I imagine, managing treasury, we at Artemis use a bank to manage our treasury, right? And so it's I see this like stablecoin crypto companies versus bank actually play out here too, where it's not just about a year bearing stablecoin. There's these like other services that now are competitive against each other.
Yeah, I mean they're absolutely becoming competitive, right? So I mean, what did Genius Act actually allow? It basically allowed for narrow banking, right? Narrow banking is making a comeback in the U.S. That should scare every single bank out there. There are 5,000 banks, chartered banks in the U.S. Even before stablecoins, probably 4,700 of them have no reason to exist, right? They're just like clearly not, offering any differentiated service whatsoever. Like they're just a legacy of what was a very fragmented banking system, right? And so we've started to see all of these technology companies, the Coinbases of the world, Bridges of the world, et cetera, say, hey, they're going to go get OCC chartered, right? Because of the Genius Act. And they're going to go get OCC chartered, but they're probably going to offer at least the first narrow banks, and they're going to figure out how they, call it expand beyond there, right? So that's number one. But then what you see is, I talked about the Governor Waller's speech that he did at the Fed at the Payment Innovation Conference 2 weeks ago, and specifically talked about this thing called the skinny master account. Now, this is early stages. There's just something they're thinking about, but it's basically allowing access to Fed payment rails, not the discount window, not lending, but Fed payment rails to technology companies and stablecoin issuers to offer, call it, more, I guess to be able to offer the same level of access to, liquidity providers and bank networks and distribution partners as the banks themselves, but to do so in a limited way where they can build really digitally native first, innovative payment solutions on top, right? And so if I say, okay, well, now I allow narrow banking for specific purposes, I'm going to give up probably 200 new OCC charters in the next couple of years, which seems to be what they say that they're going to do. And then I'm going to allow for payments innovation to happen that connects directly into the Fed through at the technology, the PSPs, et cetera, themselves. The banks have absolutely no right to win anymore other than around credit creation. But credit creation is directly a result of a deposit base. A deposit base that if they cannot get yield and they cannot get good digitally native products will erode, right? So I over the weekend, I was opening up a new bank account, right? And, I banked with Chase for a long time. We have a lot of money at Chase. And, I'm looking at Chase's highest tier checking account and savings account. Now, they're like wealth management products, et cetera, but the highest tier checking and savings account. Their highest tier savings account, without going to like JP Morgan, like private banking, was offering me 40 bips in the savings account.
Oh, wow.
Right? Yeah, that's the highest tier for having, and like I think the minimum was like you have to keep $200,000 in it, et cetera, right? And like imagine why would I keep any money there? Like I can go and get yield from all of these different platforms that are easier to use, more digitally native that are actually at any given time. And so, do I take my direct deposit into Chase still? Yeah. And you know what I do? I move it out every time, right? And eventually, like I might not even take my direct deposit there. And so my point being is that the banks are still not competing, right? They understand this like narrow banking thing is happening. They understand that this stablecoins are going to potentially erode deposit base if I also can do innovation elsewhere for payments. And they still have they're still not competing because they need to offer me the depositor low yield to be able to make spread on the lending that they're doing. But that deposit base is going to erode, which should theoretically also raise the cost of capital, which then should make banks even less competitive in credit creation, right? And so it's a bit of a this kind of slippery slope, circular thing that's happening. And all of a sudden, you look at the banks and you're saying, unless you have real scale, unless you're J.P. Morgan, unless you're kind of one of these big G-SIBs, unless you have real scale, like it's hard to see how you compete going forward on any vector relative to tech first, digitally native first payments company, relative to some of these specific narrow banks, and then relative to what will be, call it the insurance companies and the alternative credit providers out there who will now have cost of capital that might be closer to you if the deposit base arises. So that was a really long-winded answer, but I am pretty bearish most banks in the U.S.
Yeah, especially because they don't give out free pens anymore. It's like, what's the point? All the interest. It's just shocking. Our second chart that really just only goes up over time is this chart of essentially card spend on stablecoin rails. And actually, Artemis, we recently released a page where you can track some on-chain card spending at Rain, which obviously Dragonfly is an investor in. But obviously, if you look at the data, it's absolutely compelling. Rain went from about $2 to $4 million of on-chain spend in January 2025, and is now at almost $200 million 10 months later. This chart is probably one of the fastest growing I've seen in crypto. But what's also interesting is that even though stablecoins, are disrupting these, traditional payments methods, Rain does run on Visa. So Rob, a lot of questions here, but I'm curious, how do you think these Visa systems, these legacy payments and stablecoin systems interact? Is this like a new opportunity for Visa to onboard all these customers that are not traditionally served?
Yeah, 100%, right? And so two things are happening with Rain, and like you mentioned, we're an investor. One is that they're serving clients who are already have cards, traditional clients who want to be able to do better money movement globally, who want to be able to reach more customers globally more easily, right? With somebody who has, call it a global compliance footprint, who's able to do KYC, AML, and who's able to, potentially settle in stablecoins themselves. And so Rain has actually a bunch of, call it traditional clients who are, swiping the card and then they're actually swapping fiat to stablecoin and then they're settling with Visa in that stablecoin itself in some sort of potentially emerging market using Visa's auth and their those rails. But then obviously a big part of their business today is also all of these people who are looking for ways to use and spend stablecoins, but to date haven't been really able to use them at the merchants, right? And so we've seen them really large growth in Rain, but Rain is powering people like Cast and Plasma One and Avalanche's card and EtherFi, and they're doing. I think they publicly announced a couple of the exchanges. I don't know which ones are public and which ones aren't, so I don't want to say it. But they're kind of winning all these clients, which are saying we have big stablecoin balances that we know people want to be able to utilize, and the quickest way to do that is to be able to utilize them with a card that is able to get to do the authorization directly on traditional and existing rails, but then do call it the money movement on the back end in stablecoins. And one of the interesting things about Rain relative to some of these other cards is that they have the ability to do everything entirely on chain, from taking the stablecoin, providing credit real time from a credit pool that they have on a thing called Credit Coop, to then pulling that stablecoin, programmatically out of any wallet that it sits in, to sharing interchange fees with customers or clients programmatically on chain, to then securitizing any of that credit and then settling with Visa in stablecoins. And Visa actually talked about direct stablecoin settlement at their last earnings call, about how that's been still relatively small for them, but that's actually a big one of the fastest growing parts of their business. And it's much better from a cost of capital perspective. And then what happens is, right now, the merchants mostly want to take fiat, and so you're still going through the acquirer. But like, let's imagine a world where Rain is the issuer, which is they are today in many of these cases, but then the stablecoin or the merchant wants to actually take stablecoins because then it's usable on that side as well. You could theoretically replace the acquirer as well, which all of a sudden, what does that mean? That means, similar to the conversation we just had, you've gotten rid of the banks again, right? Because you've replaced the issuing bank and you theoretically replace the acquiring bank. So that's a long way out, but like, it's really interesting what we're seeing in terms of bypassing a lot of these traditional banking rails.
I mean, I think that's really fascinating, because we were chatting about this in Money 2020, where it's like, I think I really like your summary of that we're seeing this sort of fourth-party model for payments really collapsing, and Rain is like shrinking that to a two-party model, and the banks are the ones that are losing out. And I think that to me is like, I think it's going to happen much faster than people think, and I think like that's why now everyone is paying attention. And I don't even know if like most banks are even aware of this at all. Do you think like these issuing banks are concerned, or are they just like oblivious because of sort of innovator's dilemma?
I think people are starting to understand. I think Governor Waller's statements 2 weeks ago, I actually heard a lot of people talk about that at Money 2020. That was, I think, something when Genius Act happened, and then when Governor Waller made those statements, I think people had to take notice, right? There's still, I think, especially for the large banks, there's a perspective that we have these huge deposit bases, like we're still going to be able to provide low cost of credit. Like we have this, the stickiest thing in financial services is your direct deposit bank account, right? And so like, people don't want to switch that. And so they still believe that they're going to be fine. But I think everybody's thinking about it right now. Fifth Third Bank, right? Which I don't know how big Fifth Third Bank on a relative basis is, but call it a mid-sized bank, not a GSIB, but a name that a lot of people know, right? The CEO got up on stage at this Fed conference that I'm talking about, and he said, somebody asked him, he's like, listen, do you think that the incumbents like you are going to be able to adapt quick enough to a world where stablecoins are used, or do you think that the innovators will win? And he directly said on stage, and it was publicly televised, if history repeats, the innovators will win, which is why Fifth Third is trying so hard to get ahead of it right now, right? And so like, that tells me that banks like Fifth Third, and if Fifth Third cares, then every bank smaller than Fifth Third should care. It has to be thinking about this right now and how to react and how to set themselves up for future success.
Yeah, no, that's pretty stark difference in language from over almost 2 years ago. The last emerging trend that I want to cover is X402 volumes. I, for one, welcome our agentic commerce overlords, but we're still seeing very small payments here, volumes. It's about 400 to 500,000 a day, even though it was just released back in May. And for those who are unaware, X402 is a protocol for allowing payments to happen essentially through HTTP. It was created by Coinbase, and the idea was that payments would be handled over Coinbase's base network. So Anthony, what do you actually think about this? Do you think there are actual opportunities with agentic commerce, or are we still early?
I think there's a long-term opportunity. I think we're still early, and right now, I think most of it is just marketing and like kind of rebranding of traditional API-powered payments. I mean, at the end of the day, like, we at Artemis are building agents too, and the way that you access an agent is actually through an API. And so, I mean, I get that a part of agentic payments, like, hey, one day agents will be transacting with each other. These agents may not be like humans. They may not have like a a social security number, or like you can't really even KYC it. But I think we're still a bit a ways from that, and it's early.
Rob, as a VC, what would be an interesting pitch for an X402 agent that you would get excited about?
I got to be honest, I'm kind of not excited, which I think is so. I'll take a step back, right? What is X402 really? Like it's really, you called it a protocol, but it's really in many ways just a standard, right? And it's a standard how to think about, money movement, utilizing agents and AI, right? There's also a lot of other standards that exist. OpenAI has one, Anthropic has one, Google has one now. There's a few others, right? It's very unclear to me like what standards are going to exist in the future around how to move money through agents. Vast majority of people today who are doing money movement through agents, which are very, very few, are just utilizing Stripe's APIs, right? To Anthony's point, right? I say this, and we've been having this discussion internally a little bit, which is that we've seen so many payment AI agent protocols raise money. We've seen a lot of them raise money in pretty hot rounds. Some of them raise money specifically around payments, and we've set all of them out because when you have 6 or 7 warring standards alone, right? Let alone how you think about, the core infrastructure and how people access it and how it gets distributed. It's really, really hard in my mind to make a singular bet, right, around what this looks like in the future, because the market actually doesn't exist yet. What is happening right now is we're seeing, it feels a little bit like the early days of, people talk about how the internet started in, I guess, 84 or 82, right? But the intranets and the internet kind of existed before then. We just didn't agree on a standard until then about how the internet would grow. And then the internet really grew, right? And so for us, and my perspective has been that, okay, maybe if it's a best-in-class team, we'll back them. But for the most part, we're looking for companies that are using traditional distribution, traditional rails, and maybe, future-proofing themselves, to Anthony's perspective around agents, but net new types of payments that are focusing on these types of agentic commerce. It's really hard for me to see how you could build for that today when there's just no commerce there today, right? You have people building for something that doesn't exist yet, right? And I think there's a key point to make there as well, which is that the market, when it doesn't exist yet, is but it's like a hot category like this. It still requires a lot of forethought from a lot of the incumbents, right? And so, I said at Governor Waller's thing at the Fed a couple of weeks ago, there was 2 things that they talked about, and actually Money 2020 was the same way. There's 2 things they talked about. One was stablecoins. One was agentic commerce. Agentic commerce is so far behind stablecoin usage right now that it's so theoretical, but people all believe it's going to happen, but nobody has any idea whatsoever about what that will actually look like. And so investing in that category, unless it's core infra that could serve a bunch of different people, is really, really hard.
Yeah, no, that makes sense. We might as well agree on something first before we actually start throwing money around. Rob, my last question for you. Almost a year ago, you wrote Stablecoin Payments, Who Actually Wins? Who won this year? And how would you change the article at all? Or how would you update a version for 2025?
Yeah. So, all right. When I knew you were going to ask me this question, I had to go back and look at the article to remember exactly what I said. And I read through it again, and I think it's pretty much exactly how I feel today, right? And so, on the settlement rail side, or the blockchain side, we're continuing to see a lot of competition around, okay, well, where will payments actually happen on chain? Today, to the report that Anthony talked about that we helped out with, stablecoin payments still exist on Ethereum and Tron mostly, right? But there's Tempo and Codex and Arc and Plasma and these guys that are trying to compete for that, and we're seeing that as incredibly valuable. I think even some of the more general purpose ones, Solana and Monad, are really, really focused on payments, right? And so I think we're going to continue to see a war there. The issuers all trying to do things beyond issuance to differentiate their business. The PSPs, a few of them have done really well. We've seen these rumors around, BVNK getting bought for, up to $2 billion and others. And, then we've seen, I think, a lot of the stablecoin powered fintechs grow and raise big rounds and grow really quickly. So I think a lot of what I said has turned out to be, I think, pretty true, to, I guess, pat myself on the back on this podcast. Appreciate you giving me the opportunity. But like, I think that maybe the one thing that has really surprised me is probably just how quickly the fintech apps have grown that have grown on stablecoin rails. So, and the belief that this is happening globally. So, I wrote in that article that doing a new direct-to-consumer fintech is really a knife fight, and it's really hard to win distribution. But the growth we've seen across, call it traditional guys who like a dollar app in Colombia who started serving SMBs on stablecoin rails has been just way quicker than I would have thought, right? And then you have the more crypto natives like the Casts of the world who are serving that group, who have also seen a pickup of people wanting to actually spend their stablecoins at a rate that I think surprised me, even as big crypto bull. And so that's probably actually been the biggest winner of the year in terms of new money put into, from a VC perspective, more interest, ability to earn money. It's been the stablecoin powered fintechs specifically. They've been the biggest winner, and we've got one or two bets there, but we probably haven't been as exposed to those fintechs directly as we maybe should have been.
Yeah, it's I'm glad there's so many winners. We just want to keep going up. We just want to keep putting the supply up. Rob, thank you so much for joining us. This has been extremely enlightening. And I believe both of you will be at FinTech NerdCon Miami in 2 weeks. Is that true?
Yeah.
That's right.
I will be on stage with Sam Berner from Andreessen and Amit from BVNK to talk about stablecoin payments.
I mean, huge shout out to Simon. Sorry, Rob, for, Miami, November. It's cold everywhere else. What better place to do it? Rob, how about yourself?
Yeah, I mean, that's how he convinced me. It was like, okay, well, I can either go all the way to Argentina for DevConnect, or I can take a 2.5-hour flight to Miami and sit in 85-degree weather when it's 40 degrees in New York City. And yeah, same thing. I'll be there. I'd love to connect with anybody who wants to connect. And I'm doing a panel with Nick Carter and two other people debating around, and I apologize to those people that I don't know exactly who's on it right now. But basically, we're just talking about like, will stablecoins overtake traditional payment rails for traditional payment use cases, or do we think that it'll be kind of a separate category? So,
wow, we'll have to have a who did it better, Anthony or Rob, battle of the conferences. Rob, where can people find more about you?
Check out my Twitter at Hadick, my last name, HADICK, Matthew for my middle name. And, or you can find me on LinkedIn, but I'm less active there.
And Anthony, how about yourself? Where can people find you?
Yeah, you can find me on X at my full name, Anthony Yim. Or you can also find us at Artemis.
Yeah. I'm a boomer because I still say Twitter and not X. So.
Yeah.
No, I'm with you. It's just so hard. I have to force myself to say X.
Well, this is the old podcast, folks. You get the old people today, everyone. Sorry about that. If you haven't already, please subscribe to Tokenized on Apple, Spotify, or wherever podcasts you get them. Finally, if you enjoyed this and you want more, leave us a review. It legit helps others find the show. Stay stable, everyone.